one such extraordinary personality is Mr. V. Ramanamurthy. Sir has been working in the banking industry for the past 32 years, and his key areas of specialization are corporate banking, trade finance, and treasury management. Currently, Sir is the Executive Director and Head of Financial Institutions India International Banking at Royal Bank of Scotland. I request Sir to kindly enlighten us with his views.
Distinguished Dr. Anil Keskar, distinguished Dr. Bhama Venkatramani, distinguished other speakers on the dais, distinguished faculty members from Symbiosis campus, friends and students. Basically, since I represent, as Dr. Bhama requested, I am supposed to be covering from my experience and the challenges in the banking industry and opportunities, etc., as an experienced foreign banker. So I have divided my presentation in 4 parts, briefly on the macroeconomic risks, what we are going through for the past 2 years, given difficulties we are facing in Indian economic industry, and background about Indian banking scenario, key challenges currently being faced by banking sector as a whole and foreign banks in particular, and what opportunities are emerging on account of various challenges. I firmly believe in every challenge throws up an opportunity to grow and to sustain. It's not that this opportunity, the challenge will scare away and to run away. Already I think my earlier speakers have covered mostly on the financial inclusion, and I think Dr. Amit has covered about this mortgages and mostly on the credit card side and this one. So my part of the discussion will be much lesser, so therefore I will try to not to cover those areas where been already adjustedly covered. So, but I will just highlight whatever is necessary from a student's point of view. So, agenda is macroeconomic risks, Indian bank scenario currently, key challenges and opportunities. The Indian bank scenario I just covered, starting from how the banks are regulated, what are the current regulations, etc. Is basically just for information. I don't have to run through, but I just highlight key features. While financial systems remain robust, there are threats to financial stability from issues such as global sovereign debt crisis, as well as domestic issues such as growing fiscal deficit, widening current account deficit, and structurally high food inflation. As we have been going through for the past 2 years, we had a luxury of a good economic growth, good credit growth, and as a result of stimulus granted by Government of India in 2008 crisis, we have seen a lot of development in the last 4-5 years, but that has created a lot of inflation, and again every boom followed by some kind of depression cycle. That's what currently we are going through. Some say it is stagflation, some say it is inflation coupled with lack of economic growth. Now what here I mean to say that currently, thankfully, during the last 5 years growth and starting from 1977 after banks nationalization, our financial systems became very robust and strong, but still there are some threats to stability on account of this ongoing global sovereign crisis. As all of you are aware, in Europe is the Spain, Greece, Italy, Ireland, this crisis is going on. Before that we had a crisis in 2008. As a result, our economic stability is also to some extent linked with the global stability as such. On top of it, we have our own domestic issues, like as all of you may be reading from the newspapers, fiscal deficit as a percentage of GDP has been growing, and current account deficit is also growing. That is, our export surplus is not there because of huge increase in the oil price and commodity imports, and all the costs are going, very well. Now currently the dollar was ruling around 57 rupees earlier, but now it has come down to 54 thanks to RBI intervention. So therefore it's coming, but we need to see dollar in the should be in the region of around 50 rupees or so. Therefore economic activity can revive. On top of it, there is a high food inflation is also happening, but if the monsoon is going to be good in this year, this season, hopefully the food inflation can be controlled to some extent. Current account deficit is being increasingly financed by debt flows threatening long-term stability. What's happening today? Government of India is spending more than what it is collecting by taxes and loans, etc., whatever they've been getting. So there is still surplus, there is still shortages there, as that shortage is being taken care by they are taking debt flows from the market as well as from outside flows. That is not a good sign as such. Risks to domestic growth are accentuated by fiscal and external imbalance, particularly foreign exchange markets. There will be oil prices and normal monsoon could revive the domestic economy. What I am to say is that domestic growth, as a result of this global crisis, and we are also facing issues like this oil price rise, commodity prices slightly decelerating, but otherwise because of this various factors and because of our imbalance in our current account balance, the dollar has become more and more expensive. That is threatening our domestic economic growth, because the higher the prices, the corporate margins are going to be affected. The higher the prices, the inflation, as a result, even the individual incomes will be spent mostly for the consumption of other expenses, etc. Domestic GDP growth, it used to be around, as we have read from the newspapers in the past 3-4 years, it was hovering between 9 to 10%. We were proud of the fact that India has been growing faster than any economy. I mean, we have been, there were comparison to even China, etc. has taken place. But in the last 1 year, thanks to this global crisis ongoing, as well as this current various fiscal lack of slowing down the economy as such, so our domestic GDP growth is expected to decline to around 6.5% to 7 current 2012 from 8.4 last year. This is what they say, but I really don't know whether the figures are how accurate it is. But fact of the is that, but there is a slowing down is happening among all the sectors: agriculture, services, industries. Even fiscal deficit is also about 7.8% which was of GDP, which was not the case earlier. The fiscal deficit was in the region of 4 to 5%, which has gone up. But the government has to take steps to control the subsidies, to revive the economy. They need to reduce the taxes, maybe to raise more income tax, etc. from the individuals. The government has to find a way. Say someone was asking how to tackle subsidies. If you control the subsidies, then poor people will suffer. So there is only ways to collect more and more taxes from higher income people, or as the case may be. Inflationary pressures were there, it is moderated, but the risk remains due to supply bottlenecks. Today what's happening, individuals are earning, but then the incomes are disappearing. As Ajay has mentioned in the first couple of slides, more than the food inflation, today people are spending more on the communication and transportation, etc. This is basically the result of inflation. So now inflation pressure is happening basically because some say due to supply bottlenecks. If food prices are going up, or if the commodity prices are going up, or electronic goods or whatever goods we are buying in the market, these are going up, is basically, they say the supply bottleneck, government need to address it. Banks are, apart from the fiscal deficit and current account deficit, which I have been elaborating for the past 2-3 minutes, coming back to from the finance system point of view, I can proudly say banks are very well capitalized through trends in asset quality and ability to withstand sustained liquidity pressure. We have seen after banks nationalization, definitely as Ajay was mentioning in the beginning, public sector banks started learning from what's happening from the global banks and private sector banks. So that is one reason why banks started coming out with the public issues. As a result, they have strengthened the capital. So as of now, banks are well capitalized, but still, that is as per the Basel III norms, banks are required to raise much more capital from the market, but there are problems in raising the capital also. Basically with the old generation private sector banks and cooperative banks. So I can say today public sector banks, including State Bank of the Group, is controlling almost 2/3 of deposits. But I can tell you, at one time when I started my banking years before, we were told public sector banks contributing, I would say they had a market share of around 95%, only 5% is with the private and foreign banks. But today the trend is reversing, thankfully, due to the new generation private sector banks like Axis Bank, HDFC Bank, ICICI Bank. They have been coming out with innovative products, and they have been launching new products. They are recruiting skilled manpower. They don't have any legacy to carry forward, so therefore they are able to capitalize the opportunity. And as all of us know, public sector banks had its own problems like human resources, and they have got their own legacy issues. But I can say that still public sector banks will continue to rule for next 10 years until otherwise they wake up much faster then. PSU banks still dominate Indian bank system. ICICI, HDFC, access account for significant shares from private sector banks. Their share will only grow unless otherwise the public sector banks wake up and try to come out with new and more innovative products. And as I mentioned to you, our Indian economy is affected because of the deepening crisis in the euro areas like Greece, Spain, Italy, Ireland, and continued global slowdown have a cascading effect. What is exactly we mean? I can say personally, I have been reading the newspaper articles. I being a foreign banker, we keep getting a lot of research articles, research reports from internal sources. So I try to read and as far as possible, depending on my time schedule, etc. By nature, Indians are working very hard, and they think thankfully because of generations of our habit, we like to save money for our future generations. So therefore, we are always hardworking. That's the reason why today, if you see, whether you go to Europe or you go to USA, everywhere you find Indians. You go to USA, you go to any town, any city, go to Europe, you go to London, everywhere you find like India. Basically because they are the hardworking people that are wanted. But what happens in Europe and America, basically talking about Europe, the people are used to comfortable life and they are used to certain comforts left, but which was not supported by the economic growth in the respective countries. As a result, today they are paying the price. It was the case, if you see 2-3 decades back, we used to work much harder to keep up with the trend with the Europe, whereas they had a good time. For example, in my bank, when earlier it was ABN AMRO Bank, when I used to call Friday around 6 o'clock, "Hi, Mr. Murthy, why you still working? It's weekend time. So we have another 15 minutes to answer your query." So that is the way they have been working. So now today they are paying the price. Today, at one time, Greece is supposed to be one of the developed economies. Today, what's happening? Spain is one of the beautiful countries, but today they're languishing because of crisis, because there is no money for them. So they're trying to get some finance support from Germany, France, as the case may. They're in fact thinking of breaking from Europe. Italy is the same situation. Ireland had the same problem. I hope more countries should not join. Otherwise, that will have an impact on India in particular. Why? Because we are in the midst of growth, but we depend on in the foreign economies also. If we have to export the goods, there has to be demand from the foreign countries also. That's very, very important. If the global economy is going through crisis, we may be working hard, but at the same time, we will have our own problems. We will not be able to export. So as a result, today, Indian economy is highly depending on the oil imports. Oil import prices are going up. We are in the midst of infrastructure economy. We are building roads. If you see in every part of the city, there are flyovers, there are roads, there are a lot of power generation industries coming up. There are a lot of refineries are coming, a lot of fertilizer corporations are coming up. But for all these things, you need funds. You need foreign funds to import equipment. So government of India, thankfully, they have liberalized a lot of imports. As a result, they have been importing, they have been allowing imports, and at the same time, they have been allowing individuals also to spend more foreign exchange. They have been allowing all kinds of comforts. As a result, now today we are confronted with the deficit on account of foreign exchange. So that's one thing I feel, but I think government might take some steps in terms of boosting exports. Like I think recently we heard that Reserve Bank of India has increased the export subsidy to enable for banks to lend more to promote exports. At the same time, they are also trying to fine-tune some of the rules and regulations whereby banks will not be playing with the foreign exchange market, so that will stabilize the foreign exchange. So that there are government of India with the support of RBI is taking some baby steps, but still we have some more time to take care. I hope in the couple of months or maybe a few months, I think possibly we should try to control this dollar price to 50 rupees level. I just wanted to briefly touch base upon on the bank sector as such. It's basically very just common things. Basically, our commercial banks are governed by Reserve Bank of India, where we have very strict regulations. NBFIs are like HDFC, IDFC, they are all basically involved in mortgages, they are in the transportation infrastructure industry. We have companies like Mahindra Auto Finance and Shriram Transport Finance, they provide consumer loans. They are basically contributing disintermediation. They are acting actually like a neck-to-neck competition with the public sector banks as well as the private sector banks. That, as I said, the disintermediation is going to catch up much faster than what it is to be. We have, apart from the commercial bank segment and NBFS segment, we have mutual fund segment. We have already a speaker to cover that particular area. Mutual funds are basically covered by SEBI. They're basically regulated by SEBI. Then we have another industry which was niche industry. At one time it was dominated by LIC. Now today that sector is also opened up. Now foreign companies are allowed to invest up to 25% of the capital of insurance companies. This is one segment which will be opened up further. If it opens up, there will be more foreign inflows will come. I think there are some bills are pending with the parliament today. If FIs are allowed to increase the capital up to 50%, then insurance segment will revive much faster than what it used to be today. So today, thanks to the competition from this private sector insurance companies, HDFC, ICICI, etc., LIC share started reducing. It used to be dominated by LIC 10 years back. Today, LIC share is only 60 to 65%. So already 35% market share is captured by the new generation insurance companies. Reserve Bank of India regulator, we have commercial, cooperative, NBFI, FIs, commercial banks cover SBI and all public sector banks and private sector banks and foreign banks. The ownership pattern basically is there is an investment cap by 5%, a cap on investment in NBFIs at 10%, voting rates are restricted to 10%, so they wanted the banks to be controlled, it should be widely held as far as possible, although the capital can be held by individuals more than 10%. There are restrictions on foreign ownership in banks. They don't want, Reserve Bank of India do not want foreign companies to control Indian bank sector as such. So therefore, there is a limit of 20% on that. In the private sector, that's for public sector banks. Private sector banks also, one can hold capital up to 74%. There are again certain caps are there depending on the type of foreign ownership. So FIs cannot exceed up to 49%. Then we have, there are restrictions to voting rights. The regulatory thing is basically, as all of you all know, that basically every 100 rupees when bank collects from the deposits, banks are supposed to maintain SLR 24%, they need to maintain CRR, currently is around 4.75%, the rest of the money, this 100 minus 28.75 is available to the banks to lend to the industry, that we should know. So here again, then there are regulations like private sector where 40% of the advances to be given to the private sector. This is part of the financial inclusion package. They need to lend to agriculture sector. They are also supposed to lend to small scale industries, and there are certain areas where they can also provide 1% incentive whereby government of India is giving some interest subsidy. As of now, Reserve Bank of India regulates a lot of interest rates as such. Today, any bank can offer interest rate, there is no ceiling. If you see that today 4% was the ceiling some time back, now today some banks like IndusInd Bank, Yes Bank are giving as high as 7%. So that means there is a lot of catch up from the other generation new private sector banks, particularly public sector banks. If the interest rates are going to be this way, the deposits will slowly move to this, the banks which are giving high interest rate. This is something, and we all should know that. And there are certain controls on the interest rates. Basically, the rates what banks are supposed to charge has to be linked with a base rate plus margin. So whichever bank offers the lower base rate, lower margin, the business will go to that bank. So that's again, there is a competition between the banks, that is public sector, private sector and foreign banks. There are certain incentives for the loans to farmers. There are some interest subsidies that are available. There are some encouragement to farmers if they repay loans on time. As all of you know that today the capital requirements are covered by Basel II, that's for banks and NBFIs. The Basel III norms are going to be implemented at any moment of time. They have been given sufficient time, but I think it's a matter of time Basel III norms will be applicable. Basically today the capital requirements are around 9%, Tier 1 capital should be around 6%, the rest has to come from the Tier 2 capital. There are some capitals, perpetual bonds can be taken as the capital. A Tier 1 capital. There are certain provisions are there for standard loans. This basically all the loans attracts 0.5% subsidy, 0.5% of the provision. Same way RBI has also come out with a lot of regulations on provisions also. Basically, if there are NPAs, banks have to mandatorily provide up to 70% unless they are specified or unless they are allowed to reduce percentage. Today, every NPA has to be provided. NPA means non-performing loan. Banks have to provide up to 70% minimum of the loan in the books. So therefore, that much amount of profit is going to go from the balance sheet. So basically, RBI has liberalized interest rates mostly on the funding side as well on the deposit side. It's a question of efficiency is going to play. Now today, Basel II norms are basically driven by how much bank is lending to the corporates. That's what. But as all of you know that as first speaker has already covered, the Basel III norms are going to be implemented that will require banks to provide operational cost also. Today what's happening with the knowledge building up, with increased IT background and with a lot of work in the banks are outsourced to third party services, etc. There are all kinds of frauds are coming up. I have recently attended one seminar convened by PNB and Central Bank of India last week. I was surprised to know how people are misusing the ATMs, how people are misusing this wrong addresses, wrong emails. For example, if they come to know the password of somebody's, if you overhear the password also, they can use the same password, they can draw the money from the system. So suddenly you may find that your account has balance has gone. So with IT, a lot of system stability is happening, business is growing, but then there is scope for fraud. There are some, I believe there are some fraudulent elements are in the market, and at the same time there are also reports that inside within the bank in collision with a third party, frauds are being committed. So therefore it has become imperative on the part of the regulators to impose capital requirement of operational efficiency. That means every bank has to have a ORM like operations management. They will be evaluating every procedure and they will certify if the procedure is foolproof, then only they will be allowed to be launched and implemented in the bank. This is how we have been functioning. So therefore, if you launch any product, there has to be foolproof. Otherwise, there are enough crooks to try to siphon off the money from the bank system. So therefore, apart from the normal requirement of capital for the funding, banks are required to provide higher capital for the operation. The banks which are having the better operation systems and better internal audit control systems, internal management systems, they will be getting exemptions on the capital provision. So therefore, in good olden days, I mean today also, anybody, if you need lend, means obviously you need to provide only capital for the loan section, but that is not going to be the case in the next 2-3 years. So that's when the RBI is studying, they are evaluating and waiting when the banks will catch up to the operational efficiency, then they might accept Basel III. And secondly, as once Basel III is going to become implemented, it's going to be implemented in a formal way, banks need much more capital than what it is today. As I think Ajay mentioned about 60, something like $60 billion he was talking about it, is a fact. So where are they going to raise the capital? Today the markets, there are none of the public issues are successful because our economy is downturn. So therefore, even if they introduce Basel III norms, there is no way they can raise the money. And government has no money to put more money into the public sector banks. So they are stuck now. So therefore, the Basel III norms implementation, I think it is a matter of, I think maybe a few years until the economy revives, until the investors gain a confidence in putting more money in the issue, then only banks can raise more money from the capital market. Banks. This is exactly as I mentioned about how the loans have to be provided. All the standard loans will require minimum 0.4%, non-perform loans have to be provided, and there are various classifications like doubtful loan assets, etc. Now, one important thing I wanted to address when I come to the challenges, that's regarding IFRS implementation. Today, restructured accounts are basically, whenever there is a crisis in an industry, they go with a delegation to the Ministry of Finance, and they go to the Ministry, they go to the Reserve Bank of India, please allow us, give some relief, so therefore don't classify as an NPA. If it is an NPA, it means obviously the company name will be spoiled in the market. So therefore, the restructured accounts are increasing. I will tell you when I go to the next slide actually. There are some norms like banks cannot lend anything and everything to one particular group. If it is a single company, is 15% of the capital up to the 15% of the capital of the bank can be given as the loans to the corporates. Group companies can borrow not exceeding 40% of the capital and reserves of the bank. NBFC has also same rules. There are various exposure norms are there. So it is not that means Reserve Bank of India is trying to control the banks lendings. Otherwise, if you lend everything to Reliance Group or if you lend everything to one group, if that group grows, means obviously the banks can collapse. So it is a matter of how you take care of the industry. advanced diversification as such. I just covered on the bank side just so that it will give you a flavor about, but of course there are some nitty-gritty that can be seen from the presentation. Now my next point is on the key challenges what currently bank industry is facing. NPS were very much under control, as Amit was mentioning some time back, but again, as I said, because of the ongoing global crisis and because of the lack of domestic economic activity, because of credit, slowing down the credit economy, credit growth, etc., NPS have grown by 44% as on 31st March 2012, far outstripping 16.5% growth. That means advances are growing at the rate of 16%, whereas our NPS are growing at the rate of 44%. As all of you know that you all must have studied in graduation, when banks lend after meeting this SLR requirement, when they lend balance money to as a buyer for loans, the money will come back to the banks again. So the banks recycle the same money again and again. So therefore, the credit activity has to grow on a spontaneous way. Then only the economy can revive much faster than what it is. So if the credit growth is slowing down, there is a danger for Indian economy. So government has to take some steps faster. So therefore, the credit growth should continue. Restructured loans, they say this may cross up to 2 trillion by March 13 if situation deteriorates. There are stressed sectors like power, airlines, textile. We all know that power sector has got exposed about 5 trillion rupees, iron trillion about 1 trillion. As a couple of speakers already mentioned, most of the banks are depending on for the purpose of deposits in the top 100 cities. Rural areas is still not covered as a part of financial inclusion. Banks have got an opportunity to grow and expand into the rural areas. CASA is the main key factor for the success of any bank, because the higher the CASA, the net margin can grow. So therefore, that will be better for the banks to sustain in the long run. There are constraints on the return on equity because of growing operation cost, IT costs, and human resources cost, and compliance cost. As a foreign bank, we are facing enormous amount of tasks to control, to manage our compliance requirements. We have requirements like EU requirement, we have requirements like US Fed requirements, we have requirements wherever we are present, we need to comply the local country regulations. So therefore, we are confronted with various regulatory compliance, otherwise we cannot do the business. So the compliance costs are increasing. So therefore, sometimes some products may not, at the outset they may be looking good, but from the profit point of view, they may not make any sense. So wherever we feel that product is not profitable, we may either try to slow down, or we may try to find another way of making more revenues. As all of you know that because of this ongoing global crisis, there is a global liquidity shortage. Today, if companies want to raise money, they need to pay higher interest rates in the international market vis-a-vis what they used to pay 2 years back. Earlier, just about a year back, banks have raised 5-year loans, even 10-year loans at the rate of LIBOR plus 250 basis points, etc. Today, you will not get 5-year loans less than LIBOR plus 400. So that kind of rates with the forward cover, you will not be able to survive in the market. You cannot lend at a good margin to the industry. High interest rate regime, because of this inflation pressure, Reserve Bank of India has increased interest rates. That is also impacting NIS growth of the banks. Banks need to diversify the revenue streams more on the fee base. They need to find constantly more and more avenues to increase the fee based revenue. Return on assets was much better at one time, but it has come down in some cases of the banks as well as 1%. Public sector banks are facing increased competition from new generation banks, as I mentioned earlier. As I said some time back, mid-sized companies are going through some kind of a debt restructuring. They are queuing up before CDR, corporate debt restructuring, asking for a release from the Reserve Bank of India. So that is going to be some impact on the banks until otherwise the economy revives. So they say there are SME loans around 70 billion at stake, and that may increase to 200 billion if the economy doesn't turn around in the next 6 months. As of now, total loans referred to the corporate debt restructuring it has shown an increase of about 3-4 times growth. There is about 800 billion from 250 billion in last year. Public sector banks, as Ajay was mentioning, they are expected to lose the people because of ongoing retirement. Many people have they have got service another 4-5 years. So mid-level and senior level people will be going. So there is a challenge in terms of recruiting young talent and train them to take on higher responsibilities. As I said, banks are well capitalized today, but they will face challenge of growing business because of capital constraints and requirement of capital to cover operations risk as per the Basel III norms. Achieving financial account inclusion is an agenda all banks are supposed to do, but from foreign banks point of view we have limited network, but I come to the opportunity where we can tackle the financial inclusion from the foreign banks point of view. High IT spend is necessary. IT means information technology spend is necessary to upgrade the existing system and to launch state-of-the-art technology products. Banks need to find ways and means to outsource some of the services to reduce IT costs, because if we keep spending on IT costs, we have no money left for the bank to survive. So therefore IT costs are growing, so therefore you need to find a ways to share the resources of third party banks. That's how, for example, we in bank we have centralized all our trade operations and cash operations centrally in 1 or 2 locations all over the world. So most of the bank branches are basically front office functions. Their back office processing like trade LC negotiation, confirmation, discounting, all these jobs are handled centrally in one location. Therefore, we have reduced our operational cost completely by at least about 70 to 80%. Otherwise, the corporate sector is asking for more and more services at a ridiculously low price. So if you have to survive, we need to cut down operational cost. So this is something I think public sector banks have to catch up. I think private sector banks have already caught up. I think ICICI, HDFC, they have already centralized a lot of their operations centrally. I think Axis is also on the way to do that. There are some challenges for the banks, including foreign banks, adoption of IFRs. Today, and I being a qualified accountant, I know there are various ways we can show better profitability by fine-tuning the balance sheet and by accounting our way of advances, etc. But then if IFRs are implemented, then you need to comply with international practice. There will be a lot of challenges in terms of recognizing income. There are a number of this IFRs are nothing but currently we have accounting standards promulgated by Institute of Chartered Accountants of India. They are converging to IFRs. So banks have to, they were about the international practices, especially loan loss provisions. There will be a lot of stringent norms. Today, any industry can go to RBI and ask for a relief for interest waiver or interest concessions. That will not be possible if IFRs are implemented, because IFRs are strictly monitored under international purview. That therefore, if any loan becomes problem, you need to provide for the loss. You cannot try to postpone the provision indefinitely, taking advantage of the CDR mechanism, etc. So people have to be trained. Banks have to spend a lot of money on this, and there is a requirement of amending existing laws. Taxation is an issue. There are some incomes which should be which needs a altogether complete different treatment. Each bank follows different kind of treatment, but some treatments may not be allowed. So some incomes may have to be deferred for the next year as such, but unless current practices. So the IFRs are very stringent on the fair value, using as a measurement of base for evaluating international finance statements. There are, for example, I believe real estate industry accounting is slightly complicated. Now I believe real estate, until the project is completed, you can't recognize income. But today they are recognizing income on the basis of the stage of construction. So that may not be permitted if once IFRS is implemented. So that's where today Government of India, as well as in consulting with RBI, is slowly they're trying to buy some time to implement IFRs. If IFRs are implemented, then there will be more challenges for the public sector as well as private sector banks. As you know, recently a couple of FIs have questioned the profitability of some banks and some NBFIs, saying that as per the international practice, the profit is shown much higher. So therefore, these challenges are going to come when more and more equity capital is going to be owned by FIs and foreign companies. Reporting systems will be very stringent. And thankfully, foreign banks, to a large extent, implementing IFRS as a global practice. So therefore, for us, we have no choice, because we are governed by requirement from head office. So therefore, we are following. In fact, 2 days back, there was discussion in our bank. If you implement this IFR means, then I'll have to postpone the recognition of income to next year. So they were debating how to avoid or how to try to find a way out. As all of us know, frauds are increasing among all the banks, whether it's the public sector or private sector or foreign banks. There was a fraud recent in Citibank where the bank has lost about 300 crores. This is something which has to be managed at all levels by increasing all the systems, especially the risk management has to be strengthened, and you need to adopt global practices to try and control the risks involved while extending loans to corporate segment. That's one thing very important. If the risk managements are not robust, there is a possibility of losing more money by NPS among the banks. As I said, frauds are increasing. They're showing increasing trend. So management has to adopt a 5-point formula. Like you have to. There should be a tone at the top in organization with multiple stakeholders. There is a growing need for board of directors involvement in controlling frauds. Detailed fraud risk assessments like KYC, compliance on ongoing basis. One has to keep developing new procedures and try and implement to prevent potential frauds. One of the objectives of fraud risk assessment is to basically help focus management attention, so therefore significant frauds can be addressed. It is one can stop the, but we have to also find ways to prevent based on the experience. So therefore, procedures have to be continuously evaluated and changed accordingly. You need to detect and you need to find ways to prevent also. And if there is any fraud takes place, you cannot take months together to investigate. You have to swung into action to recover the money immediately. If you find there is a fraud has taken place in a bank and some customer has walked away with the money, you need to first, instead of filing a case with the court and going to the police station, by that time the fellow will walks away with the money. So therefore you have lost the money. So therefore banks have to find a ways to control the frauds with a quick, strong and fast action as such. So therefore the frauds are also is going to be a problem for the banks, including all of us. Particularly foreign banks, public sector banks and private banks they are able to expand because RBI allows them to expand the network because they enjoy liberal rules. But as far as we are concerned, we are strictly regulated. RBI releases licenses based on the receivable. We cannot expand just at the whims and fancy. If we are expanding, they will say, "Are you allowing me to?" allowing Indian banks to expand the business in your respective home countries. So there is always a strict control. There is queue of foreign banks waiting for getting licenses. But now, the share of foreign bank business in India remains low because of the limited branch network. And especially after the 2008 crisis, some of the banks, in fact, they reduced retail bank business as such. There is a growing pressure on the foreign banks at home to ring-fence expense investment banking business and refocus on the basic banking, which require altogether different strategy. What's happening because of the 2008 crisis? You know, the Lehman Brothers, AIG, the number of banks and companies have failed. So that is basically because of the investment bank activities. Now there is a pressure on because when the banks have failed, governments have to fund those banks to survive. For instance, our bank has got about 40 billion funding from government of UK. US has funded a lot of funding support to Citibank, Bank of America. It is the case with most of the foreign banks. So because of these problems, foreign banks are missing chance to grow in India because India is a huge country to grow. India is such a country where there are a lot of opportunities, but then because of home country problems, they are missing opportunities in terms of capturing the growth share in Indian market. So there is some opportunities there. I am coming in the opportunities. I'll discuss a bit more. So we need a growing pressure on the foreign banks basically to ring fence investment bank activities. So therefore they need to come back to the basic banking like commercial banks in India. So therefore they need to do normal lending, which will have lesser scope for any frauds or which will have lesser scope for losing the money. European banks especially, which are confronted with the problems at home, as I mentioned about Greece, Italy, etc., they're facing a lot of problems. They're missing phenomenal business opportunity in India and China. Domestic liquidity is an issue. But there is a strong focus on attracting NRI deposits to meet domestic business. If you see more and more in Indian banks, private sector banks, including foreign banks, we are coming to a lot of attractive schemes to raise more NRI deposits to tackle our liquidity domestically. Because of limited network, we can't collect deposits from the rural sector or small towns as the case may be. We have no luxury like a public sector or a private sector banks. And we have a major challenge on global growing compliance cost. We need to follow, if you are present in USA, US Fed regulations, we need to follow EU regulation if you are present. We need to follow OFAC filters. We need to follow UK if you are opening a branch, if you have got branch network in UK. So we are a UK-based bank. We are confronted with the US regulations, the EU regulations, UK FSA regulations, and they are committed to follow the local regulations where the banks have got the branches across the global network. So therefore, this is going to be a major challenge for foreign banks. But as I said in my opening remarks, every challenge will throw an opportunity. Every difficulty will be followed by there is nothing as such can be solved. It's known that foreign banks have limited expansion growth basically because of RBI's restrictions. Now RBI has come out with a very interesting proposal. It is in the discussion with various foreign banks. They say you ring fence Indian banking operations, you float a company. In lieu of that, you will enjoy a lower tax and you will be allowed to expand freely in India. So therefore, by ring fencing Indian operations, by forming a separate company in India, you will enjoy tax benefits. You are allowed to expand business and branches like any public sector or private sector bank. This is a fantastic opportunity, and this will work wonders for foreign banks, and they can also follow this. They can also comply with the financial inclusion act. By opening branches in rural areas, they can raise more deposits in the market. But then the discussions are going on. There are certain nitty-gritties has to be resolved with the concerns of the Bank of India. Local incorporated foreign banks will be required to recruit best management graduates, CAs to expand their network. So we always look for the best talent in the market, best management graduates and CAs as the case may be. So therefore, there is a good opportunity if you are allowed to form. If most big foreign banks, if they form companies in India, they can have an opportunity to recruit more people from management campuses. As I said, opportunities are concerned because of costing, growing costs in the trade, etc. Centralization is a must. We have followed rigorously. I think more and more foreign banks are doing, and more public sector banks are also going for centralization of trade operations to cut the cost. Further penetration in rural area will happen once we are allowed to expand more branches by virtue of this proposal of the subsidiary. Penetration of debit cards, there is a huge scope in the rural sector. There is a growing demand for fee-based business from the transaction bank service. Electronic channels are going to be robust in the near future. Today, you can transfer money wherever you want by following NEFT within, I think, up to 6 o'clock or 7 o'clock. But they say there's going to be 24/7. Anytime you can transfer money anywhere in India by NEFT. And there are payment mechanism platforms are coming whereby payments can be settled across the instantly wherever. So the paperwork will reduce. Small private banks need to work on strategy to have a minimum number of branches to share higher operation costs and growing establishment costs. This might result in merger of some of the weaker banks with the big private sector banks. Already SBI Group is consolidating. State Bank of Indore and State Bank of Saurashtra has already merged. More and more SBIs will they will merge with the State Bank of India parent. So that will be a fantastic opportunity. So that will reduce the operation costs because you use the same IT platforms, you use the same operation cost. So this is one fantastic opportunity going forward. Cross-border trade will take first baby steps towards document imaging. Today, any trade business happens physically acceptance of document that will reduce because documentation image is going to be a future business. This happens, huge trade opportunities, trade business will happen between the corporates using this document imaging technology. Domestic trade business will be done through swift messaging. Today what's happened, if you have to do any business with any corporate customer, I need to get an acceptance of the bank, physically handwritten signed. But today that can be minimized if you follow SWIFT. Then worker acceptance is one area where a lot of NRI deposits can be captured. Mobile banking, I think many people have talked that's a future. Today you can instantly, you can transfer the money, you can access your account using mobile at your home. So therefore you need not go to the branch to visit. So this is one important opportunity for most banks, including foreign banks. Foreign banks which are on short of the demand liquidity, they will be launching more plans to tap NRI deposits. Likewise, foreign banks which are flush with foreign deposits, they are in a better position to provide long tenor foreign currency loans by MTN programs, Indian fresh listed bonds. So we are very strong in foreign currency deposits. So that is the one biggest factor for our survival in respective countries wherever we are present. So that comes to my presentation. If there are any questions, I'm happy to answer. If students have got any issues on opportunities in foreign banks, that could be one thing I think a lot of students would be wondering. So I will be happy to clarify if they have got any specific queries on that. quick, I think this time is.
Sir, I have a question regarding the foreign banks expansion in India. As we know that when the financial crisis happened, everybody took their capital out of India. And a week back there was news that the foreign banks want to expand more and they are asking RBI to remove the regulation that the number of branches they can open. So is there a contradiction, like there is a crisis going on in Europe and the banks are looking to expand in India? So how to address this contradiction that there is a crisis and they want to expand?
Yeah, but as I said in my this last slide on opportunities, I do not think any foreign banks taken any capital out of India. I don't think so, barring even small foreign banks. But otherwise, Citi, HSBC, they all retain their profits and capital in India. In fact, RBI is giving a wonderful opportunity to ring fence its Indian operations by forming a separate locally incorporated company, so that will allow the foreign banks to grow, irrespective of the problems currently being faced by the foreign banks at the home country, in home country. So in fact, that is a good move on the part of RBI, because I have been listening to some of this RBI dictates and some comments. The foreign banks, they come and if their business is not there, they wind up and go. So that is RBI trying to control that. So they do not like that. So therefore, they continue in India to grow and to take the piece of the Indian economy. So that is how they want us to grow the business. That's why Standard Chartered Bank, I think HSBC, Citi, they are all thinking of forming a local incorporated company. So therefore, they can continue the operations. I'm not talking about the small banks, which are very niche business like trade finance, etc. Otherwise, most of the foreign banks, I think they are in a growth mode.
So I have a question. Do you think that in the global banking crisis, this diversified funding is that two-thirds of the equity, banking equity is held by PSU banks? Okay. This diverse funding by the PSUs, private banks and foreign banks, they are not shareholder funding is very comparatively quite insignificant. So that has helped India to weather this banking crisis. And that is one aspect. Second aspect is that bank is paying. So compared to other foreign counterparts, the bank is pays and compared to the dollar. So these two aspects are, do you think that saved India from the banking crisis?
I want you to just simplify your question, so therefore I will be able to answer clearly. What is exactly your, basically you are talking about foreign banks supporting Indian economy by way of participating in loans, etc.?
Not that. So I am thinking that the diverse funding pattern by the banking sector, between, say now, Western banking world, what is happening? They are nationalizing the banks. We have got a network this nationalized in India. But in Europe, other countries, America also, they are nationalizing the banking sector.
Right.
Because rival nationalization country.
Right.
So we are only having this bottleneck. My question is whether, according to you, just saved our banking crisis, particularly to us.
I tell you, from our experience, after this 2008 crisis, you are right. The respective home country governments have taken stringent measures in terms of taking charge on the banks. As I mentioned in one of the slides, they wanted to ring fence investment bank operations, which is very expensive to run the foreign banks. So they wanted to separate those activities and they wanted to focus on the commercial bank business. That's one regulatory. The respective home countries are imposing controls on Citibank, RBS, etc. So that's the way. If you see most of the foreign banks, they're separating this the expensive investment bank setup. They wanted to you to focus on commercial bank like what Indian private sector banks and public sector banks are doing. That's one step. Second thing, wherever if the banks are need much more capital, respective governments have injected capital, whether UK based banks or whether US based banks, this happened, but they wanted to protect their capital. For example, Citibank has got taken a huge amount of help from US government. Now Citibank has repaid the loans, but in no way that affected their growth pattern in our country especially. So there is no such thing as capital taken away from our country by any of the foreign banks as such. Yeah, that was the last question.
Sir, what are the challenges faced by the foreign banks, especially for maintaining the 40% commitment as stipulated by RBI for funding the priority sector?
Yes. As mentioned earlier, foreign banks have got a limited network, unlike Indian banks, like public sector, private sector bank, they have got a huge network. They have every scope to comply with this priority sector advances comes up to 40%. Whereas we are not present in the rural areas, we have no scope to grow. So therefore, we have got a exemption from RBI to maintain the private sector up to 32% instead of 40. Even out of 32%, we have got certain exemptions whereby we can buy some agricultural bonds floated by NABARD, etc. So therefore, we are able to manage 32%. But we can't escape from the private sector norms. But at the same time, we have got some exemptions. Till such time, we are allowed to expand branch network in India. So once this subsidiary company formation, if it happens, if it is going to be formed as a local company, then we have no choice. RBI will ask foreign banks also to maintain the 40% priority sector norms. We need to do that. There is no choice. At the moment, it is 32%, which includes small scale industries, etc. But exports are again not covered by this 32% priority sector advances. So 40% is applicable only for the public and private sector at the moment. Okay, thanks. If there are no questions, I think.
Thank you very much, sir. That was indeed insightful.